Welcome back, investors. Today, we're decoding how hedge funds measure and report their performance. Let's explore some key metrics like Sharpe ratio, alpha, and beta. First up, the Sharpe ratio. This metric tells us the return of an investment compared to its risk. It's calculated by taking the excess return above the risk-free rate, and dividing it by the standard deviation of the fund's returns. A higher Sharpe ratio means better risk-adjusted performance. Alpha measures a fund's ability to beat the market. It's the return on an investment relative to the return of a benchmark index. A positive alpha indicates the fund has outperformed the market, thanks to the manager's skill or strategy, not just market movement. Beta reflects the fund's volatility or sensitivity to market movements. If a fund has a beta of 1, it moves with the market. A beta greater than 1 indicates more volatility than the market, while less than 1 suggests less. It's crucial for understanding how much market risk a fund takes on. These metrics are not just numbers, they tell a story. The Sharpe ratio helps investors understand if the return justifies the risk. Alpha shows if the manager adds value, and beta helps gauge the fund's market risk exposure. Together, they paint a picture of performance quality. Beyond these, other metrics like drawdown, peak-to-trough decline, and the Sortino ratio, which focuses on downside risk, are also considered. Performance attribution analysis breaks down where returns came from, helping to assess strategy effectiveness. Hedge funds use these metrics in performance reports to communicate with investors. These reports often include historical performance, risk metrics, and sometimes qualitative insights on market conditions and strategy outlook. Understanding these performance measurements is crucial for investors to evaluate whether a hedge fund's returns are worth the risks taken. They're the language of hedge fund performance. See you in our next video on investment selection in hedge funds.